the offers at this stage, but that's actually not where the interest is. The interest is actually on the bids. Because what should happen, obviously, if the price moves really quickly, is that bids will probably drop off because they haven't refreshed behind the market, right? So when the price moves higher, sometimes what happens is the bids drop off because they haven't refreshed in behind the market. But if you see the bids actually refreshing in behind the market going up like this, that's better evidence that the market's going to keep going up. That's strong evidence that the buyers are refreshing quickly and aggressively behind, because they're the guys that are right in the money, right? These are the back pressure trades. So when the market's rising, I'm not actually that interested in the offers. I'm actually interested more in the bids. When the market's falling, I'm actually more interested in the offers. So when I see the market starts to rise here, I see the market's rising relatively quickly during this period. You can see the bids actually increase during that period. So because the bids are still increasing during that period, and you can see that, that means that they're refreshing the buy orders behind those bids during the up move, because they should be moving away from the bid, shouldn't they? The green line should have been dropping. The green line was actually rising. And that tells me that this is actually a really bullish move that's going on just now. So you can see that that leg higher there, they didn't refresh the order book, did they? Do you see that? See the difference, Miguel? On that leg higher, that big up candle right there, they didn't refresh the order book behind it, which leaves a vacuum below that price, doesn't it? Does that make sense? Does that make sense, Alistair? It leaves a vacuum behind the price. If people aren't quite getting this, guys, imagine I draw a chart, right? I'll just draw the candlesticks first, and I'll draw just a move up and a move down, since it's quite an important point, since obviously some people have not quite understood the way that this liquidity is perhaps printed. If this price is moving up, one would imagine that if it's bullish, the buyers are going to keep the bid in. The market makers are going to put the bid in behind the price, and they're going to pull the offers above the price. So as the price moves up, the idea is that they're going to put the bid in behind the price. The bid in behind the price as it moves up, right? So they're putting the bids in behind the price as it moves up. And what are they doing above the market? They're going to pull away the offers. They're going to pull away the offers. They're going to pull away the offers. They're going to pull away the offers, right? So what does that look like in terms of bid offer liquidity? A straight line. So in other words, the bids are always the same distance away from the current price, and the offers are still the same distance away from the current price, right? So what's going to happen during that move is that the bid is going to be, the offers are always at one tick away or whatever away from the current price, and the offers just kept getting pulled. So if I was to look at the offer book would maybe be doing this, and if I was to look at the bid book would be doing pretty much exactly the same, right? Now, what happens if the offer stays the same? And what happens if I get more aggressive on the bid? So what happens if I get more aggressive on the bid? So when that price moves up, I am basically following it through that process. As the price moves up, I'm following it through the process here. I'm actually putting these in. I'm lifting the offer. As the price moves up, I'm putting my bids in behind the price, right? I'm bidding my bids in all the way behind the price. I'm marking up the price literally. So what's going to happen to the green line? The green line is going to be going up, right? We're going to start seeing the green line moving higher during that period against the red line. Now, what happens if the liquidity starts sticking? What happens if they don't pull away this time as the price trades up into this area? The price trades up into this area, and for the first time, it actually hits into that liquidity. What are you going to see? Well, it depends what the bids do. Because what happens if the bids don't refresh? What happens if the bids don't refresh and the bids actually just stay here? Or, worse than that, they actually pull away the bids. So what's going to happen to the bid book is it's going to drop off, isn't it? It's going to drop back off again. What's going to happen to the offer book? What's going to happen to the offer book? The offer book's going to spike because they left the liquidity in place, right? So the offer book's going to spike because they actually left the liquidity in place, and you're going to get that type of order flow candle, aren't you? So we can start to recognize that type of order flow candle there becomes possibly a sell. Why? Because look at where the bids are. There's a vacuum behind that offer, isn't there? So there's an actual vacuum there that allows you to look at that and say, wait a second, there's a vacuum opened up between the bids and the offers. Well, worst case scenario is I might be able to make a scalp trade against that vacuum, correct? If I see the absorptions, of course, using that book, if it's not too far away. So there's probably a little vacuum in here because it's been created by the fact that the price has outran the liquidity. If the price outruns the liquidity line falls instead of refreshing behind it. If the liquidity line is fattening behind the trade, then the trade is going to keep going higher, one would imagine, because everybody's going to see that. So it becomes very important that we watch these two lines in unison. So I can see that there is I can see that there is a very, very definite vacuum in here that I can take advantage of as a trader. I can sell some scalp trades on the S&P there at 43s, and the price drops down to 42s, and I make myself not a very much money, but I make myself some money off of that trade right there, right? Make myself some cash off of that bit of business. And obviously what happens is that those vacuums keep appearing. See how the vacuum keeps appearing? See how it appeared there once, and then it appeared here twice? The price isn't even going up, and that vacuum keeps appearing. So somebody keeps flashing those offers onto the book, which means I am going to take advantage of those by selling some 43s. And those little sales at 43 took me down to 41s, and that's a nice trade outcome, isn't it, when you start seeing those vacuums forming in terms of the limit order books. So you can see these vacuums at times. You can see that we start to get a kind of more a vacuumous buy side book during this period. You can see the vacuum forming during these areas. Now remember, I want to be on a downtick, so like a candle like this has a vacuum. The offers did not keep track of the trade downwards, did they? The offers didn't keep track. If the offers kept track on these fast candles, the limit order book would be a straight line, not a declining line. And therefore the offers didn't keep pace. That leaves that candle open to a reversal, doesn't it? So there's a higher probability of a reversal on a candle that looks like that. And that gives us a scalp trade that makes us some pretty free money. Yes? Now I want to see those big down candles. There's another big down candle here, and we can see that the same type of situation happened at the same time. Now it pinned and reversed, but that's okay. You still have been able to scratch the trade at that stage. But this is what you're kind of looking for as a trader, isn't it? This is the kind of ideas. Now, obviously, if the noise in the background of the market depth is too much, you can take it off, guys. But obviously, you're going to lose all the detail. If you don't want to take the noise of the limit order book off, you can reduce the sensitivity somewhat so that you can actually take away most of the noise and leave just the big thick areas of liquidity. So you're actually watching for these. You're watching for these vacuums appearing, especially when the price maybe doesn't move. So I can see, for example, there's a vacuum appears on this candle. You see that? The vacuum appears on that candle, which means that's probably got more likelihood of reversing and the price goes up than the next candle. There's more likelihood on that candle of the price going up, and the price does go up on the next candle. During this phase, there's more likelihood of the price going up, but it's obviously on an uptick anyway, so there's no trade here. But you can see that they're not filling in the order flow just now on the sell side, are they? So if I can get a trap trade down here, there's a nice opportunity to buy that, isn't there? If I could get a trap trade down there, I could buy into those areas. And sure enough, there's the price of way up again. See it? See how easy it is to trade that order flow storyline, Alistair? Does that make sense, Michael? Trading the order flow in the tape becomes really quite easy. The bigger the vacuum, the bigger the opportunity to take a trade on. And there's a big vacuum here between the number of sellers on that downtick, because when that price has been falling, they have not added a single contract behind the price. So it's moved away from the supply, hasn't it? It's outran the supply, hence the reason why the supply lines dropped off here. If we look at it from the kind of market profile not market profile, from the book map concept. Do you see how the area in here goes very dark from sell side liquidity? There's hardly anything in there, is there? You see that? There's hardly anything in there. So in other words, the sellers never filled in behind that trade. They just never filled in. So that leaves the up move very, very open to exploitation. We can see in this big up candle here that there is quite a sizable gap forming on the up move, which kind of runs again. It's outran the demand at that stage, hasn't it? It outran the demand at that stage, but you don't want to just do it based on one candle. You want to do it based on candles plus absorptions that show that the sellers are real and all of those kind of things, so you don't get trapped in a spoof. But this looks as if it's outran the demand. And obviously, if it's outran the demand, I would rather be selling it than buying it. So whichever market is at the top edge here, whichever market is visible at the highs, that's the market I would rather be in if I'm going to be trading this. So at the moment, I would rather be a buyer. So I'm going to be watching this phase here to try and find out where those buy opportunities may be at the bottom edges. Because you can see that the selling liquidity is not keeping pace with this down move. Now that can change, of course. So when you see that dropping down, I'd rather be buying into the low price to take the market back up off of those down candles. Now I don't see any big absorption selling, but you can see what's happened. We've just won another trade there, see it? We just won another trade there. Makes it dead easy for us to win easy money trades by following the price and trying to capture a little bit of a trap trade somewhere. Now this is going to chop and change, guys. You're going to be backwards and forwards with your thoughts all the way through this. So the best way to use this is to trade it against levels. So if you're going to trade it against levels, all you do is you now find where the previous level was, and you find out where the top edge level was, and you don't do the trades unless you're getting to those levels. You just keep those in mind, and then when you get to those levels, you look to see whether they're filling in behind it for a squeeze or whether they're pulling away from it for a reversal. And that's what you start searching. You can see that they're pulling away the buys at the moment into this top edge here for a reversal at this stage. But that doesn't mean it's going to reverse. So we're watching for that stop run. The buyers are starting to fill in a little bit behind that candle, so you've got to be careful. You want to see that red line spiking, not the green line spiking behind it. So that's not a sell candle right there. That's not a sell candle. You see that? See the difference? Because I saw that big up candle, there's no way that green line should have been green. No way that green line should have been rising, rather. So when I saw that green line rising, that's not the candle I want to be selling. That's not going to be the candle I want to be selling because the buyers are filling in behind that candle. So that enables me to not sell the highs and the price rallies up through that price. I'm able to stand aside and watch the price rallying through that little bit of price action there, and I don't get trapped into a short trade. But you can see that your buy trade, the buy trade we called for you guys, actually was the right trade. Look at how much money that buy trade made. It's perfect, wasn't it? So what's happening now? Well, you can see on this up candle here that you can see that that is a sellable up candle because it's into the prior highs. It was into the prior highs. It wasn't great, but it was into the prior highs, and you can see that there was a drop off in the buying. Now, I'd like to see a bigger drop off than that because it's not great. I'd love to see a bigger vacuum. The bigger the drop off in the buying, the bigger the vacuum, especially if it's a big up candle. But you can start to recognize that if you were going to sell it, that candle there could have been a sell if we just got a little bit more liquidity. If we just got a little bit more liquidity in that trade. So you can see that I'm waiting for this buyer to piss off because this buyer's still connected with this trade at the moment, guys. So this is expected to squeeze higher. This is still expected to squeeze higher because the buy book is behind that buy absorption here, isn't it? Is that a spoof order? Well, it might be a spoof, but it depends whether you're looking at the market from a bullish value point of view or not. But at the moment, this buy book is refreshing in behind this higher price. This market tells me that it's probably more likely that the S&P will still be going up a little bit from this area, and we should be targeting up into that 44 higher price during what we can see here, right? During what we can see here. I would rather be a buyer than a seller. I'd rather be a buyer than a seller at that stage, right? And there we go, there we go, there we go. See it? See how easy it is, guys? Do you see how easy it is? So you could have bought some 41s. It's just traded 42.5. Does that make life dead easy? Does that really make life dead easy? Of course it does. Just a little bit of just a little bit of tape reading. Did we get lucky on it? Not really. We've just called a buy twice. We've just called a buy at a top edge, and we were right on both occasions, guys. That's not luck. That's just good trading, isn't it? Make sense?